All right, let's continue part 2. The bearish reversal candle is the inverse, which is with this type of a formation in a bearish scenario that you just saw here. And the image above is showing us that the price made the highest high, which is right there where you see a wick made high, which is in the circular and there's an arrow there. And then again you can see that before reversing and closing strongly lower of its high, again it reversed and closed lower. So let me try to explain that. As you can see right here, the candlestick made a high and it closed low right here. Okay, all right, that is what we are saying here. And then here is what the bearish candlestick is telling us. All right, price made a new high, but buying pressure very quickly dried up as an increase of sellers entered the market, resulting in the candle closing lower of its highs, signaling selling strength. As you can see that the market was going up, right? And somehow the sellers started interfering and they started to take control of the market, and then they took the market to the downside. This is what happened, right? This is what happened. So let's move to the second one, which is a hammer candlestick. Now we talked about this one previously on our lesson, on our beginners lesson, and I said to you I will show you in the real market how do you use it. So this is a hammer. As you can see, this one that I've just cancelled, that is a hammer, right? Now a hammer can also be used to identify the correction of the market or the reversal of the market, right? Say you are in a ranging market, right? Okay, you just spotted your trade here, right? And then what happens is that this formation here can also appear above here. So the question is, do you take a sell or do you take a buy when you see this formation appearing? Do you take a sell or do you take a buy? Right? So as you can see, the hammer is a bullish, right? And then next to it came a bearish candle, and then afterwards a bearish candle, and afterwards came a bullish candle, and then the pattern actually changed. So this is a confirmation that the market might shoot up, and a stronger confirmation also came with this engulfing bullish pattern. Okay, you see that that's another pattern for me which I did not include in this lecture. I would include it separately. Okay, I didn't put on the 3 candlesticks. I would put it separately. Okay, I would put it separately. Engulfing is also a powerful pattern to use. As you can see, it formed. Now this tells you that after here you might take a buy. The market might start to go up, right? So a hammer would appear anywhere in the market, anywhere in the market. So you just need to correlate the hammer with other patterns. I've just showing you the correlation here. Let me show you another correlation. Here is a hammer right here at the corner. This one is a bearish hammer, right? So in your mind, you might say to yourself, the market is going down. And again, you can see that the market started to go down a little bit. But next to it formed a powerful one again, which is a bullish engulfing pattern, and the market started to go up. Okay, so you need to be wise when you trade with these things. So a hammer would be used to reverse the market, to correct the market, also retracements also, right? So you can spot this pattern also on that level. So a bullish hammer candlestick, sorry about that, seems like my notes didn't print very well here. Okay, it says these candlesticks are easy to spot, and they are generally have taller wicks than the others. As you can see, it has a taller wick right here. You see that it has a taller wick. Yeah, it has a taller wick, and then the body would close like a hammer, as you can see, right? So that's why it's given the name a hammer, right? So yeah, let's try to go to this one. They tend to close with no or very little upper wick, right? As you can see, there's no wick on this one, right? Like for example, they would be like this. So in most cases, they don't close like this with the above wick. We don't call this a hammer. This doesn't qualify to be called a hammer. A hammer qualifies like this, okay, right? And then sometimes you would have a small wick, right? Not 2 or 3% above, like just 1 or 1.5%. That one qualifies to be a hammer, okay? So you can see right here, okay? So you can spot this in your trading platform, okay? And here is what a bullish hammer candlestick is telling us, right? The price opened near the high, right? This one is bullish. Remember, we're talking about the bullish one, okay? The price opened near the highs of the candle, and although sellers initially succeeded at pushing price lower, they lost the final battle when buyers tipped the scales in their favor again by closing price higher than the opening price. As you can see right here, let me explain what happened. Here we saw our hammer, and immediately we thought that the market would shoot up. Then we took a position, we put our stop loss here, only to find out that the sellers came in and they pushed the market down a little bit, tricked our stop loss, and then we're out. So in this case, what happened is that the buyers came in, pushed the market from where the sellers were pushing the market, and they closed the market up. So right here is a resistant level. As you can see, we have a support, we have a resistance, we have a support. So the sellers, they knew that when the market reaches the when the market reaches this resistant level, which is previously right here, previously was a support, right now it acts as a resistance. So the sellers, they knew that when the market reaches this level, this resistant level here, most 90% of traders that uses what we call trend lines to trade, they would go for sell. So indeed, higher percentage of them came in, they pushed the market down. Now similar thing happens. Here is the support, right? Here is the support, this zone right here, this zone right here, this zone right here. Many traders, they know that when the market hits the support area, many buyers would want to come in and buy, and indeed they pushed the market high, forming what we call an engulfing bullish pattern, giving major support to the bearish hammer. So this is a major signal for you to go buy. But again, don't fool yourself and think the market will just shoot up like this. The market will just go up like no, the market will go up, come retest somewhere, come to almost touch your stop loss, and the market will go up, right? So this is what exactly happened here. As the buyers came in numbers, the market went up, then the market came down again, giving us another engulfing and giving us harami pattern again. So this is a battle. When you trade, you must understand that this is a battle between you and other traders. Some traders, they go for buying, some traders, they go for selling. So you are in a battle. So always watch your charts and put your stop losses relevantly, you take profit relevantly. Okay, so we are done, I think, with the bullish. let's go to the bearish. Okay, let's look at the bearish hammer candle, aka inverted hammer. These bearish formations are simply upside down hammers and are also known as inverted hammers. Here is what the bearish inverted hammer is telling us. Price opened near the lows of the candle, and although buyers initially succeeded at pushing price high, they lost the final battle when the sellers tapped in. I don't know why my system cuts the words like this. Wow. All right, but I can explain it, no problem. Let's go to it. So this is what happened, right? As the market was going up, the market is going up, the market is going up. When the market reaches this resistant level, the market started to retrace. And when the market started to retrace this level, at this level, this pattern came, right? This pattern came, formed. Here, what we call a bearish haran came. Now, it tells you as a trader that there is a slight possibility, if not higher possibility, if this is not a retracement, it is a reversal. It tells you that if this is not the retracement, it's a reversal. But you have made your analysis, you know that this is a reversal, it's not a tracement, right? Because tracement are on a smaller time frame and reversals are on the bigger time frames. Okay, so now you understand that here I'm going for shorts, I'm going for sells, right? After you see this, but you don't just confirm with one system. You have, remember, multiple systems that you use that will tell you what's happening. So the inverted hammer appears with a wick larger at the top than the body. Okay, so what happens is this is a bearish one, it's a vice versa. A bullish one would be like this, right? This goes up, this tells us we're going down. Okay, after you have analyzed your market, as you can see, after this appeared, then the market went down. That's a lucky, that's just the pure luck, right? Sometimes the market doesn't go down like that. Okay, all right, let's talk about flecked doji. Call it the doji, you know, no need to glamorize the names. Doji. What is a doji? Doji has two systems, right? There is a cross and there is also an equilibrium between the buyers and the sellers. So a doji can be more or less similar to this, right? It can be a half body, full half body, with a similar percentage from the down, similar percentage to the up, right? So these are two examples of a doji, right? So again, a doji will appear either on the bullish market or on the bearish market. A doji may appear right here to tell you that the market is going up. A doji might appear somewhere to tell you that the market is coming down. So a doji is a reversal pattern. A hammer is a reversal pattern. Okay, these are not continuation patterns or candlesticks. We have continuation, we have reversal, we have retracements, which are same things, right? Retracements, reversal, same thing. So let's say the market is going up, boom, 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 right? This doji appears here. What are the chances that the market will do? Continue going up, or chances are high that the market might come down? Which one is it? Obviously, chances that the market might come down, because this is a reversal sign. This is a reversal signal. Once you spot it somewhere here, let me do this. Let's say the market is going like this. Then you spot it here. There is a possibility that there will be a retracement up to this level. Then from there, another doji appears here. There is a possibility that the market will go up. You see that? That's how you spot it. On a bigger time frame, when this happens, say the market is going up and this doji appears here, this is a bigger time frame. Possibility that you might take your profit here and here are high. The market might reverse. Retest, break, retest, go, retest, break, retest, go. You understand? So that's how you can spot your doji. Now, how is a doji formed? Like I said, it can be just a cross without the body, where the wicks above can be similar in percentage with the wick going down. Okay, these two wicks, they can be in almost similar percentage in length, right? In length. Okay, so what is a powerful combination of a candlestick pattern that you may use to confirm that the market will give you a major retest? This is the one right here with the doji. For example, if your market is coming from above, is going down, right? And then this candle becomes bearish. A doji appears in the middle. The next candle becomes bullish. You know you have high chances of the market going up. Another one, if the market is going up, right, and this one becomes whatsoever bullish, then a doji appears, and this one becomes bearish. We have a strong chance of the market going down. This is another powerful pattern that you can use. We have evening star, we have morning star. You know, there are many. We have three little soldiers. There are many candlesticks that you can use. So as you're looking at the picture, you can see that this one is a doji surrounded by the bearish candle, which is a larger, surrounded by another another candle, which is a bullish candle, which is a larger candle, and the doji is in the middle, right? Sorry, I wanted to highlight this one, and the doji is in the middle. This is a powerful signal that tells you that the market is it can go up. And as you can see right there, they've highlighted that flanked by two large candles. So if a doji appears between two candles, let's say for example a doji appears between two bearish candles, what do you think will happen? Where do you think the market will go? It can be a continuation. If the market comes from down, it can be a continuation that the market will go up. But there is a slight possibility that not that far up, somewhere, somehow, there will be a retracement. And if it appears again, now changed the formation, this one will be pure bearish, and then the next one will be bullish, and then this one bearish. The market might reverse from going up, going down. Okay. All right. These are reversal patterns which are formed with three candlesticks. Okay. Bullish flanked doji. Okay. The middle candlestick being the doji candle, which is then flanked on either sides by two larger candles. And then doji candlestick generally show up at areas of indecision, right? And they are defined by their very small bodies, which tend to form around the middle of the candlestick length. Now the part where is called indecision, this is where the part we call equilibrium, the part where the buyers and the sellers, they are equally in the price, right? They are met equally in the price. Like, remember I told you, it can come in this form or definitely in this form. Okay. What is a bullish doji candle telling us, or candle formation is telling us? The price came from down strongly into an area where sellers were dominating, but there was a period of indecision at the next candle because price went up and down, not finding any real direction. This indicates a balance between buyers and sellers, and at the very next candle, buyers tipped the price into their favor, right? And then again moved the candle to the upside. So what is a bearish flanked doji? Let me show you here. Here is another one. Sorry. Here is another one here. You see that? And here is another one here. Right? You see that? And here is another one here. You see that? So sometimes you might win your trades, sometimes you might lose your trades. This is trading. Win, lose. Sometimes you might win. Okay, so it's trading is like that, man. It's trading simply like that. So yeah, a bearish doji would appear at the top of your what is this now? It slipped my mind. At the top of your movement, okay, at the top of your movement, whether your movement is bullish or bearish, it might appear at the top. Now, what do I mean when I say whether it's bullish or bearish? For example, here it is. If you have a movement where the market is ranging, right? The market is ranging. This can appear here, right? And again, this can also appear here, right? So you need to have another type of a system that will confirm to you that you need to enter or not. Sometimes it might appear here above but not give you the whole movement. It might retrace somewhere due to certain reasons, or it might give you the whole movement, and it can appear again down here, and then you think the market will go down, but the market can go up, right? So in this case, what's happening is that the small to no body part appeared, flanked by two large candles around. So now how do you tell that this candle would go, this formation would be bearish? This signal is a bearish one. Remember I said it. I said if the market is going up, if the market is going up, for example, the market is going up and the market starts to retrace at this level, right, which previously was a support, now it was broken, now it became a resistance, and then this pattern appears, you look for two things. If your doji is just simple a cross, you look here. If the candle is 100% bearish because the market was coming up, then the next sort of bullish because the market was going up, the market gave you a bullish sign. Then on the right side, you see that the market gives you a bearish sign. Then you have a doji in the middle. You might consider this as a sell. Vice versa. If the market was coming down and then somewhere here it retested, and then this guy appears right here. He appears right here at the top, right? And then here at the top, he appears something like that. This side, he is bullish, and then on this side, he's bearish. You must know that the market will come down to retest again. What if he appears here and he's still bullish, right? He's still bearish, sorry. He appears right here, he appears something like this. On the other side, he's totally bearish, and on this other side, he is bullish. What happens? You must know that the market might also go up and retest this level. What if he appears here and then he appears in this form? Then you know the market will go down. Simple as that. This is a vice versa system. Right? Bearish reflected doji, the opposite of the previous case. Okay, this is the opposite of the previous case. And in this example, the doji had a very small body. It did have a body, and the previous one, it didn't have a body. Previous one was like this one is like this, right? So remember, you need to always confirm these signals with another system. Okay, the doji had a very small body where the bullish example had none. Okay, here is what the bearish flagged doji candlestick formation is telling us. Price moved up strongly into an area where buyers were dominating, but there was a period of indecision at the next candle because price went up and down, not finding any real direction. This indicated a balance between buyers and sellers, and at the very next candle, sellers tipped the balance in their favor and immediately moved the price lower. Conclusion: these three patterns can provide us with a powerful clues to what a given market might do next. Remember, probability. You see this coming. Right? You see this appearing. Right? You see this appearing. Right? You see this appearing, right? You have to understand that these are clues that there is a probability that there would be a reversal in the trend. If this is a going down trend, there might be a reversal, and if this is an uptrend, there might be a reversal. These are called reversal patterns. So it doesn't matter what market or time frame you are trading, just pay attention to all the major swings and highs, lows on your chart, and you will see that the patterns popping up over and over again. Of course, taking setups on reversal candlesticks alone won't work, which is why we use them in a combination with additional methods that follow a systematical approach. So these patterns, they are just one of the major characteristics that you can use to foretell that the market is coming down. Let me give you two examples. You see a market coming down like this, right? And when it gets here, it goes down. Sorry, before it gets here, then this pattern forms, right? This pattern forms, right? This pattern forms. Where do you think the market will go next? Probability, there would be a continuation to the downside. Possibility, continuation to the downside. Let's say this market comes, right? And then right here, that example I've just made comes in, okay? And then you think, because I said this appears on the is a reversal, so definitely you would just do this and say the market would go up. You might be wrong. You might be wrong, because what's happening is that this is a retest level, right? You need to put your trend lines to tell you whether you are in a retest level or not. Once you put your trend lines, you see that, oh, this is a resistant level. It means this pattern here is telling me that from going up, this is a bearish pattern. So it tells me that the market will come down again. So when the other one, which is a bullish one, comes here, it tells you that the market will go up until the market breaks and it goes up. So you need to put your trend lines after you spotted your lower highs, lower low, lower highs, lower low, lower highs, lower highs, lower highs, lower low, lower low. You know when the market hits the last lower low and it gives you a break or similar level to the previous lower high, then this pattern appears. You know something might happen here, right? So you're using three scenarios to confirm. Okay guys, thank you very much. Where you didn't understand, talk to me privately. I would try to explain. Thank you. See you in the next lecture.